Hey, this is Jake Clever again with the Block Biz. Thank you for joining me. On this one, I want to go over how the wealthy allocate capital and how you can do the same things as them in order to receive the same results and their habits and the things that they do with the money in order to keep it, maintain it, and grow it. So, wealthy people do not sell assets. They continue to accumulate assets with leverage against the assets that they own. So, what does that even mean? Right. So as an example, everybody usually understands real estate. You have a down payment, you save up money, put a down payment on a property, and you can finance the rest of the property with only 20% down, let's say. And maybe you got some money for renovations to bring up the value of the property. And you can get a tenant in there to continue to pay the rent for you. So now let's say, we'll just go through a thought experiment. It's a $300,000 home. You get it at a discount because somebody needs to get out of it for 200,000. It needs $15,000 to $20,000 worth of renovations to bring it up to code and make sure it's nice for somebody that lives in there. And you have to put 20% down, so that's 40,000 down. And you take another 20,000, you're doing renovations on the home, and it's nice. You get a tenant in there that's going to be there a long time, and they continue to pay on the property for a year. You're able to up the rent significantly higher than your payment because the collateral of the house is worth more than what you paid for it to begin with, and then you renovated it, and so the property value's gone up considerably. Let's say it went from 300,000 fair market value to 350. After the tenant has paid for a year, maybe you have $100,000 worth of equity in that property. You take that equity out of that property, you do refinance the property, and ideally you get an even lower interest rate than what you originally got into, which is what's been happening for the last decade up until here recently. And then you reallocate that down payment on an even bigger property. And you didn't have to sell the first one. You just took a larger loan against it because it appreciated in value during the time that you owned it, and it cash flowed and paid itself off, right? Or gave you more equity in the property without you having to do anything. The best assets to own or the best investments to have three things. One, they have a high ROI. They appreciate over time. And it doesn't have to be substantial, but it has to be going up in price over time. Number two, they cash flow in some way. This could be dividend stocks. This could be real estate. This could be crypto that you're staking. This could be a business that you buy. A lot of the things, right? There's a lot of options that fall into all three of these categories. So you got significant ROI, up in value over time. Two, they're cash flowing. Three, you have a way to take leverage against it. So a bank or an individual will loan you money against the collateral or the asset that you own so that you can take capital out of it without any tax implication. Because when you sell an asset, you then have to pay tax on it. But loans against an asset, not taxable because you owe that money back to whoever loaned it to you. This could even be a loan to yourself. That's what really wealthy people do. They give loans to themselves. So, and you have to have differentiation, right? So you have an entity that's loaning the money to the individual, or your other LLC. You might have a holding company and an LLC that the holding company loans money to the LLC. But that's the point, right? No tax implication. You continue to control the assets, and you can reallocate that capital to something else that does those three things again, right? So maybe you use real estate to fund purchasing stocks, to fund purchasing businesses. There's a lot of different ways to go about it. And there's a lot of different types of assets that fall into all three of those categories. And you want myself, I know a lot about a few things. And I want to find other people that know a lot about the thing that I'm trying to invest in. And I want it to be passive, and I really don't want to have to do much. with it. If it's real estate, they need to do the syndication and the property management and just pay me mailbox money. And I'm happy for them to make their fee because I know that they've been doing it for a long time. They're well aware of what they're doing and they're very good at it. Whereas if I had tried to do it, I would have a huge learning curve. I'd potentially mess it up and lose my money. And I'm probably not going to be as good as they are because they've been doing it a long time. Right. So you want somebody that has a track record in any of these areas. You might find a business broker that does online businesses, and that's what they sell. And they're able to negotiate deals and earn a percentage off of them, even equity in the business with you, right? You're putting up the capital, they're finding the deal, and you participate passively. So wealthy people own assets that pay for their liabilities. An example of this might be, let's say you want a Ferrari, okay? And you've got the money to pay cash for it. Great. Would I do that? Absolutely not. Not financial advice. I'll just put the disclaimer in here. Anything said here is educational and is for educational and entertainment purposes only. Please always consult your financial advisor, CPA, attorney before making any tax, legal, or financial decisions. So this is how I would go about it personally. I would take my money, buy an asset such as a car wash with the $500,000 that cash flowed $10,000, $20,000 a month. And I would then use that money that was coming off the car wash to pay for that dream car that I wanted. And I'll always own that asset and it'll continue to cash flow and I can take leverage against it again and buy something else. But that asset would pay for that liability. So same thing with your home. Maybe you save up enough money to purchase a duplex or a triplex or a multifamily property or a commercial property. There's a lot of different types of real estate. But let's say you buy a larger property, you save up, $200,000, $300,000, maybe less. Maybe it's $100,000, and you partner on it with somebody, and you go in on a multifamily property. It's a smaller apartment complex that needs some renovation. That's in a secondary or tertiary market that you can raise the rents on. Like I said, you probably need to find somebody that's competent in whatever area you want to get into. But this is just an example. You go in on the apartment complex instead of using that for the down payment on your house. That apartment complex cash flows every single month. Let's say that your percentage is $5,000 a month is what you get. Well, that would easily cover your house payment that you would have got for the $100,000, right? So that's how I'm thinking about things, and that's how wealthy people think about things. They purchase assets that cash flow, that they can take leverage against, and that appreciate in value, and use those assets to fund their lifestyle and buy the things that they want. They don't use money to buy liabilities that continue to cost money. Most people believe that their home is an asset. Your home is a liability. If you live in it or you use it, your car, your home, it is a liability. It's not making you money, it's costing you money. Something that's an asset produces cash flow and puts money in your pocket. Your home that you live in, unless you're renting it out, subletting it in some way, using it as a business, there are ways that you could turn your home into a cash flow asset, but most people do not. Most people just live there, and it's not an asset. It is a liability because it does not cash flow. You have to pay taxes on it. You have to pay insurance on it. You have to make your payment on it. You have to do the upkeep on it, all those things. And the cash flow off of it is nil because you're living there, and it's requiring your income from somewhere else to cover that. So if you had to put that money in another property, maybe it's another home, maybe you live in a smaller home and you own a big one, and that's hard on people's ego, but you'd be much better off financially in that situation. And over time, you'll continue, like I said, you could use the formula that I gave you at the beginning of this, where you build up cash flow inside an asset. You have a track record, got a cash flow statement and a balance sheet. You have a business that you can present as the asset. or that owns the asset that cash flows to a banker, and they will then loan you more money against it because they can see that it's going to get paid. They'll give you cash to go finance your lifestyle or do whatever else you need to with it. Again, accumulate more assets. And that's why the wealthy continue to be wealthy, and most people that are poor continue to stay poor, because this isn't taught in school. And if you didn't come from a wealthy background, then it was never taught to you. And you were taught that you go to school and you buy a house and you get married and you have kids and you pay for all these liabilities and you basically become a debt slave. And it's unfortunate that most people are exposed to that. And that's just the culture that we live in here in the US. But yeah, so just some thoughts for you guys on how I think about what I do and allocate money to, what I believe is a good investment. So just to cover that again, something that appreciates over the long term, something that cash flows, and something that I can take leverage against. That is what I would invest in personally. Again, nothing said here with financial advice, but I hope you got something from that. If you do come into money or you want to become wealthy one day, I hope that serves you well. And we'll see y'all on the next one.